half of CFOs, I think, expect one in 2019, 80% in 2020. I mean, they're really dismal folks, aren't they?
Are you that dismal?
No, it's supposed to be the economics profession being dismal. We can't forecast a recession, right? I mean, I think the problem that everyone's bugged with is the expansion can't go on for more than 10 years. It never has. So something's going to go wrong.
So the unprecedented nature of the bull run, but everyone says bull runs don't die of old age. So what exactly?
Yellen said that, yeah.
Yeah, right?
Well, so we're going to test that.
Well, we could test it,
yeah.
But let's talk about what exactly we see that is constructive. Why do you feel as though the economy is still able to sustain itself and not go into recession in 2019?
Well, assuming we get past this 16% decline from the highs of the year for Dow Industrials, that would take a toll on business and consumer confidence if it stays down here. There's really no the traditional reason for every recession ending since the 70s is the Fed raises rates too high. It's an imperfect tool, interest rates. They raise rates too high to slow the economy to fight inflation. Well, we don't have any inflation this time. I was struck by the press conference with Powell saying that pretty much would he have a tighter policy right now? And he said no. So that means even how tight is tight? That means the Fed funds rate going above 3% based on their reading of neutral. You know, their neutral is 2.5, 2 3/4, 3, somewhere in there. But he doesn't see it going higher than that. I think that's, you know, pretty bullish for the economy to continue.
So we've mentioned a lot about the flattening yield curve. There are certain parts of the yield curve based upon maturity that have inverted technically, you know.
Yeah.
Is it something we should be watching? And if so, what is the most important part of the yield curve that we should be watching for that possible recession indicator?
I guess we used to use 3-month Treasury bills and 10-year note yields, but that's too complicated. That's not going to invert for a while. People usually just use 2-year notes to 10-year notes, and it's gotten very close to inverting. I don't view that as, I mean, you really want to ask, is the inversion of the curve, does it mean that credit is tight? Is Fed policy tight? And with a 2.5% Fed funds rate, that doesn't sound like very expensive money, right? But the only thing that's a little bit different this time that makes me a little nervous, and if you're in the housing sector, you're also nervous, is that this raising of the Fed funds rate to 2.5%, it sent mortgage yields up more than they ordinarily would. So it's really, really long-term rates we're concerned about here for potentially slowing the economy.
So